Ladies and gentlemen, welcome to the Safety and Risk Success podcast. I'm your host, Christian Harris, and my guest today is Wes Sierk, and he is involved in an area called captive insurance, which is something that lots of people haven't heard of, but actually I think is a really interesting option for many businesses to think about how to better manage their risk and insurance costs, also risk management, and just generally take a bit more control on what is going on. So Wes explains what captive insurance is and how you go through that journey, what are some of the benefits, what are some of the drawbacks, and how he and his business can help. He also shares a huge raft of useful information in some links, videos on YouTube and various other things. So I recommend, once you've listened into this interview, check out the links, the videos, etc. And if you think it's something that could be for you and your business, then do reach out to Wes and see if he can help. I certainly enjoyed this one, and I'm sure that you will too. And definitely, as always, what I try to do is provide some educational content so you can learn something new. And I'm sure that many of you will learn something new from today's episode. If you enjoy this, if you enjoy the podcast generally, really would appreciate if you could hit follow, give us a review, a rating, because that really does help, and spread the word on social media. Let's get into my interview then with Wes. Cheers. Wes, welcome to the podcast.
Thanks for having me.
It's great to see you, and you're looking very dapper. For those watching on YouTube, you're going to see you're putting me to shame.
Yeah, no, don't worry about it. But I have client meetings today.
Yeah.
So when I see clients, it's a luxury to be able to dress up nowadays, because I went for a year and a half without wearing a suit at all.
It is a luxury, yeah, and you've got a great bow tie. And what I'm going to do is I'm going to post a picture of me wearing a bow tie when I put this episode out. I'm going to include a picture of me wearing. I've got a very interesting bow tie that I wear. But yeah, you're right. I mean, I remember I went to like a black tie opera thing a few weeks ago with my wife and a couple of friends, and I was really worried because I didn't really think I was going to fit into my tuxedo.
Did you?
Just if I was going to an all-day sort of thing, I probably would have said no, I'm going to have to rent something. But I was fine to kind of rock up and have a sip of champagne and then sit down, have some dinner and listen to some opera, and yeah, that was okay. But yeah, I think it gave me a bit of a kick up the butt to do a bit more exercise again.
Yeah, I had to go through a couple suits till I found one that actually fit right.
Oh, the woes! It's all these indirect challenges of COVID that nobody ever thought about.
Yeah.
But there we go. So it's great to have you on. I'm looking forward to this one because I think that what you do is really interesting and very topical, and it's something I think that the audience, some of them will obviously know about this topic, but I think a lot of them maybe won't have that much knowledge. So I think it'd be great to delve into this and give us some of your insights and talk about kind of how you can help and stuff. So do you want to just start by giving a quick bit of overview of yourself and the business?
All right, perfect. Wes Sierk, Managing Director of Risk Management Advisors. And I've been in the insurance industry since 1994. And about 2000, I was selling insurance at the time. And then I realized that the insurance companies, no matter what they paid me in commission, the insurance companies always had more money than I did. So I tried to figure out, how do I get some of that insurance company money? So I have a partner, Jared, and at that point we're like, hey, how do we become an insurance company? So it led us down the path of trying to figure out, how do insurance companies start? What do you have to do? And then that's really where we started Risk Management Advisors in 2004. So in 2002, we did our first captive insurance company. Mm-hmm. And then in 2004, we took the knowledge that we learned from starting our own insurance company and said, we're just going to run insurance companies, for ourselves, but also for different people.
Perfect. And yeah, I think you're right. Unless you have horrendously high loss ratios, the insurance companies always seem to do pretty well.
Yeah, exactly. Well, and that's the thing is, even if you do have bad claims, if you have a long-term perspective on insurance as a business owner or as a risk manager, even if you have bad claims, the insurance company is going to recoup that the next year and the next year and the next year. So if you have like a 5-year time horizon and you look at it holistically, then I think that's the way that people should look. So even if you have 1 or 2 bad years, you can still benefit from your own insurance company.
Yes, and yeah, the balance sheet benefits of insurance companies are well known as well. Could you just explain then for anybody that doesn't understand what captive insurance is?
Okay. Captive insurance is an insurance company that a business sets up to insure its own risk. So it's a licensed, regulated insurance company, but instead of paying the AIGs, the Zurichs, the Liberties of the world, they actually pay their own insurance company. And then because they don't have the same balance sheets as a Liberty or a Zurich, you go out to the global reinsurance market and you figure out exactly how much risk you want to take. Then you go and buy reinsurance to cover it. And it could be, a lot of the large insurance companies have reinsurance companies that they also own. And then you have other businesses like Lloyd's of London and syndicates where you can just basically say, okay, we're taking the first $1 million of claims and then lay off all the rest of that to somebody else. But it's really just a way for them to control the cost of their insurance, control the claims experience, which, a lot of times our clients don't do it just because they want to save money in premiums. They want to do it because they just want to control the claims experience, because the insurance companies routinely don't settle on things they should or settle on things they shouldn't. So they want that control as a business owner.
Yeah. I remember a case where a guy I interviewed on the podcast before, actually, I won't say who it is, but because it's a slightly sensitive perhaps, but a lady was in a shopping centre with her daughter or son or something. It was a mother, and there were these 2 benches which were maybe 3 meters apart, and she decided it would be interesting or funny or whatever to try and jump between these 2 benches or seats or whatever they were, and didn't make it and fell and broke some kind of bone, and then put a claim in. And the insurance company basically wanted to settle this claim because their view was, taking the holistic view of, the cost of defence and so on and so forth, better to settle it for a low amount than fight it. And this person, who was the head of health and safety, was absolutely furious about this because it's ridiculous, and we've got to we've got to take a stand here.
Yeah, there was just a case in Santa Monica in California court where a woman was in a store and she tripped over a child that was running around crazy, and she fell down and she broke her leg and tore an ACL. And the insurance company gave her a huge award, and it went to a trial, and the kid she tripped over was her own child. Her own child was running around crazy in a store, and then she trips over her own child and then sues the store because of this child was running around and she hurt herself. I mean, it's just crazy. Just this morning I was on the phone call with one of our clients for workers' comp, and they do armed and unarmed security. Basically, the armed security guard was putting his gun in his holster with his finger in the trigger guard, and he shot through his foot. And you're like, really? I mean, it's just crazy. And that's going to be a large claim to rebuild somebody's foot.
Yeah.
So.
Yeah, the system in the US is a bit different to here. We were chatting a little bit before we started the interview about this, and we don't have the kind of punitive damages. So although, taking that scenario, I guess it's less likely that would happen here because of the firearms laws here are a bit different. But there may well be a claim, but the cost, the quantum of that claim would be a lot lower here, I guess, at least, just because of the way that the court system works.
Which is good.
Yeah, I think there's having done my own personal injury claim, which the audience may have heard me talk about before. I don't know. I kind of feel like we're perhaps a little bit too conservative, and the US, my impression is a little bit too generous. So I think perhaps there's a bit of a middle ground, which would be better for all concerned, I suppose, because you don't want to be putting companies out of business with silly claims, but equally, if someone is really badly hurt and it isn't their fault, like me being run over when I was just minding my own business, standing on the pavement, you kind of feel like they should probably get a bit more than perhaps I did.
Yeah, but that's one of the reasons people look to captives, because the premium, we're in a hard market. Premiums have been going up. Insurance companies' balance sheets have taken a hit from this whole COVID. But even before that, people are talking about how insurance premiums are going up, but they've been going up globally since the fourth quarter of 2017. And a lot of it has to do with bad claims, but also social inflation of the jury awards. And that's the insurance companies are some of them are getting really, really hit hard in just social inflation. There's no reason why something happens to somebody that really doesn't cost them that much money. They had some time, they had some injury, but they get a $10 million award from a jury. And it's just, that's one reason, because you can, when it's your own insurance company, you can settle on stuff you want to settle on and fight the things you want to fight on, and pay a fair amount of money to people, but not feel like you're always, getting the short end of the stick.
Yeah, it's that element of control is always good, isn't it? We all like to be in control of our own destinies as much as we can. So are there any particular kind of sectors or sizes of business? Is there a sort of ideal profile of a business that would really benefit from going down the captive route?
Yeah, great question. Our clients typically, they have premiums that are, let's call it 250,000 pounds, $500,000 or more, where their claims experience is better than their peer group. So that's one area that we look at. And if you look at it like a dartboard, the bullseye are people who are paying premiums who have very good loss experience, because they're doing the stuff, they're implementing the stuff that you have on your podcast, month in and month out. And once they have that, then you can, where insurance companies, traditional insurance companies, a lot of them use filed rates. They don't really, they have their boxes they check. As you know, Christian, the reinsurance market is more of a negotiation. So when it's your insurance company, you go and buy reinsurance, and the reinsurance is a business to business transaction. And that's where they look at, the overall risk management of the company, and you can get some arbitrage there. And then if your claims are better than your peers, then over a long period of time, you're really, reducing the financial impact of your insurance portfolio. Or, conversely, if it's going up, you at least know why it's going up. And too often, when it's your own insurance company, you can cover the stuff you need covered. Because now with policies, too often, if you get a 20-page policy, it's 5 pages of what's included and 15 pages of what's excluded.
Yeah.
So at the end of the day, the coverage you're buying, and you think you have good coverage. The only time you find out it's not good coverage is when you have a claim and they're like, "Oh, I'm sorry, that's not covered." You're like, I thought that's what I was buying. And you read it's in the press all the time now, business interruption for COVID.
Yeah.
So many people thought that they would be covered, and they just aren't, because the property wasn't damaged. There's all of these reasons why it's not covered. But in our captive insurance companies, we write business interruption for many clients. And so far, the last number, this is as of, Monday of last week, and we've paid out over $50 million to captive owners from their own captive, covering business interruption. So it's given them the money they needed when the whole world shut down. It's given them the money to keep their business going.
Yeah, because you're not arguing. You're sort of. There's no third party to argue with, is there? I suppose you're arguing with yourself almost.
Yeah, correct. Now, if let's say it's a large international company where their business interruption is a 10 or $15 million limit, they're not covering that all themselves. You have to go to reinsurers. And if you have it on your one policy and you negotiate following form coverage, then it would be covered. But we don't have any clients that did that. The largest limit we had was $5 million.
Yeah. Okay. And are there any kind of particular sectors that it's more attractive to? So, for example, high footfall retail, where you've got a lot of public liability kind of claims versus, say, a manufacturing where it's going to be employers' liability or workers' comp, using the US terminology.
Yeah. So we have manufacturing where they're basically covering the general liability of their business. But also with manufacturing, we have a fair amount of clients where they manufacture a good and then they put a warranty on the good that they manufacture, and the warranty that they were just keeping on the balance sheet of their books as a liability has now been shifted to the captive insurance company, because the captive is actually issuing a warranty policy. We have retail where they do have people walking in, and they do have that commercial property. So let's say somebody has a large portfolio, putting the commercial property inside the captive. A fair amount right now, it's construction. Home healthcare is a larger and larger part of our practice, because the premiums keep going up and up and up, and they base the premiums on the amount of beds you have.
Yeah.
So as there's consolidation in that industry, one operator may go from 2,000 beds to 10,000 beds, and it's not just their premium isn't 5x by doing that. It may be 15 or 20x, because they say, oh, the more beds you have, there's a much higher probability of having some sort of accident or injury. So really, I can't think. So with all of our different clients, I can't think of an industry we don't have somebody in. We do, mortgage, brokers, automobile leasing companies where they're doing gap coverage, construction, home health care. We have law firms that put their medical insurance and their professional liability inside of this.
Yeah, makes sense. And are you seeing, given what we've talked about with the hardening of the insurance market, premiums going up over the last few years for all sorts of factors, is now the peak of the captive market? Are you seeing more and more people moving down this route?
I am. Last year was one of our best years ever, and this year we've already done the same amount of captives we did all last year, because it's a hardening market. So people are looking for solutions. And it's interesting because as hard as the traditional insurance market is, the reinsurance market hasn't been hit nearly as hard as the traditional market. It's been a softening market for years and years and years. And insurance companies make their money from premiums they take in, investments, and many of them have to pay dividends out to their shareholders.
Yep.
So they take in those premiums. Well, when your premiums are falling and global long-term interest rates on bond portfolios has been going down and down, and down. So they have less and less income from investments coming in. They have to pay the dividend out. One of the largest expenses they have is reinsurance. So as a result, they've been purchasing less and less and less reinsurance and hoping that nothing bad happened. And then something like COVID happens, or the floods in Central Europe, or hurricanes that hits them. And then all of a sudden the insurance companies get hit hard, but the reinsurers really didn't, because they have globally, there's a glut of availability in the reinsurance market. So that's why I think I haven't seen a period of time in my career where things have lined up so perfectly, with premiums going up, reinsurance staying low.
And what sort of are the trigger points then for people or companies, to think, okay, now's the time to look at a different way and explore captives, and how do they first kind of come across you, for example? Is it just Google searches, or are you doing sort of thought leadership and things like that?
Yeah, well, I do have videos out on YouTube. I have a full channel where I go through the basics of captives, how they work, and then I do videos for specific industries where I'll talk about. Right now, cannabis is a big area here in the United States because it's not federally legal. It's legal in many states, and the insurance companies are afraid to write it. So these businesses that need it. So let's use directors and officers insurance. If you want to attract people to invest in your business, or if you want to put really good talent on the board of your company, they want directors and officers insurance. But these companies just can't get it because companies aren't writing it. So I mean, we saw a scenario, the other day where they had a bunch of really good consumer products people that were going to come on their board, and they needed D&O insurance. So the quote they got was $1 million of coverage. It was a $250,000 premium with a $250,000 retention. So 2 years into it, you're at the amount you paid is for basically full limit to premiums in 2 years, which is absolutely insane. But it's really people that look at their insurance if they look at their insurance spend and they look at their claims. And if their claims are below 50% of their premium, then it could make sense.
So
and then when you figure reinsurance is probably, depending on the policy that you're writing and the coverage, reinsurance could be on the low end 10% and on the high end 35%. So as long as there's some arbitrage for you to do it, then I think it makes sense. It's never for our clients and us, it's never an emotional decision.
No.
It's always dollars and cents. Can you do it cheaper than paying the premiums?
Hence why it's more popular than ever, because the premiums have been going up so strongly.
And another interesting thing is when people do it, because we suffer. I mean, we had a hard market in 2010 to 13. So we have clients that set them up then, but then premiums started going down again. And once people get into a captive, they don't typically say, hey, now's a great time to go back into the traditional market. So when they do it, when it's hard, even when it starts to soften, they still keep their insurance, because the internal cost and reinsurance and everything else that goes with the softening market, all those expenses will go down also. So there's always a spread between the traditional market and your captive, all the costs all being equal. And another interesting thing that I've found is the clients that we have, they look at their captive almost like a separate line of business. And they're like, okay, I have my XYZ widget manufacturing, whatever business, but also I have this insurance business. And once they get into it, they like the way it works. They like the tax advantages. They like the intellectual. Most of our clients are intellectually curious. So at some point they're like, oh, what if I did this? And what if I did that? And what if I tweak this? And you know what? I realized, because of the pandemic, I couldn't get the supplies that I need to manufacture whatever cable or whatever. So it cost me more money to go out and buy the copper to make my stuff. So we have supply chain interruption insurance and trade credit. Somebody doesn't pay you. Well, now instead of going to the traditional trade credit route, you can do the trade credit through your own insurance company. So it's looking at the overall business, and they may start with 1 or 2 policies, and then they expand and expand and expand, and and it just keeps growing.
So it sounds great, obviously, but I guess it takes quite a lot of work to set all this up.
For a client or for us?
Well, I guess, yeah, from a client's perspective, yeah, they need, it's not the sort of thing you click your fingers and just decide to set one up. You need quite a lot of help and expertise to support you.
Yeah, correct. So that's what our business does. So we design them, we implement them, and we manage them. If there's reinsurance that has to be placed, we will negotiate with the reinsurance companies and use a reinsurance broker, and that's a business-to-business transaction. But we're I would say like a third-party administrator for insurance companies.
Yeah. So
we don't, and I think what sets us apart from a lot of other people that do this, like a Marsh, and Marsh is great at what they do. But Marsh they have a captive practice, but they're also retail brokers. Where we don't sell product, we don't charge commissions, and we don't manage money. So you'll find captive managers that set up captives for the sole purpose of them selling other products or managing the money. So all we do is set them up and run them. So it does take work on the client's part, because they have to give us good data. They have to give us the claims information. When it's their insurance company, as you know from your business, if they're paying an insurance company and the insurance company is paying for all the claims that come down the road, their mindset is different than if they're taking any of that risk themselves. And that's once it's their dollars on the line, that's when they're, keen in saving everything they can. That's when they put in the risk controls, everything, that you and all of the other guests you have do.
Yeah, it always surprises me that you have these carriers that do ground up traditional conventional insurance still. I kind of think, why are you letting clients get away with that to some extent? Why aren't you making them carry some more of this risk themselves, and then they would, as you say, hopefully be more attuned to trying to reduce losses and run a better business.
Yeah, it's kind of like you take auto insurance. If auto insurance, many people have a deductible, call it 250, 500, 1,000, whatever their deductible is. But if they were to buy auto insurance, like first dollar guaranteed cost, and says anything breaks on your car, we're going to cover it. You need new windshield wipers, we're going to cover it. You need an oil change, we're going to cover it. 2 things would happen. The insurance would become very, very expensive. But second, and more insidious, is people would start taking less and less care of their car. And I think that's what you have with many of these policies out there. Take cyber, for example. Cyber claims are going crazy. And for many years, they've had policies that basically anything that happened, the cyber insurance companies were going to cover it. And now the cyber insurance companies they're waking up and they're like, whoa, people aren't putting in firewalls. They're not locking down the computers because they don't want to anger an employee that says, oh, now I can't listen to my, phone at work because you can't plug it into the USB. I mean, all of this stuff. So they're like, oh, forget it. But that's it's taken its toll, and it's, and cyber is, this whole pandemic has really, to me, exposed the vulnerability that a lot of companies have in the area of cyber once their employees start working at home. And the claims are going through the roof.
Yeah, there are so many kind of indirect claim causation issues, aren't there, from COVID? Just the way the world's changed. Even things like musculoskeletal, working from home, and do you need to do desk reviews, ergonomic reviews, and do you need to be sending people proper chairs and desks and all this other stuff which people just weren't expecting. And I think from my perspective, what I kind of see, and I think most of the sort of insurance and safety people, consultants would agree, certainly over here, is COVID's been so all-consuming that a lot of these other things have been kind of not forgotten, but they haven't quite been dealt with as well as they perhaps would have been normally, because everyone's so focused on COVID.
Yeah, are you seeing clients and companies that are going in and doing like ergonomic reviews on their employees that are working from home?
It's starting, but we're 2 years down. We're almost 2 years down the line. So there's that gap, obviously, which presents a risk. So we are starting to see that. I think what a lot of companies have done here is sort of waited to see what the government guidance and stuff was going to be, and then they've taken a view about, are we working from home, are we getting people back in the office, are we going to this kind of hybrid model? And I think that's the time where people are now it's kind of right, now this is our official policy moving forward. So someone like Apple, for example, as I understand it, is kind of work from home as much as you want. So then I think they would be probably investing in this kind of thing now, whereas perhaps they wouldn't have done 12 months ago.
Yeah, I mean, you bring up a great point, and I don't know of any clients of ours that they have their employees at home, but that was an aha for me. Like I haven't even reviewed that with them. And it's probably something they should do. We talk about their cyber risk, but not the physical working conditions of the employees, which probably will have a longer term impact.
And the mental health side of things as well. I think that's the big sort of ticking time bomb, isn't it? That people are talking a lot about, is kind of people are more aware of mental health now than they ever were. And we haven't seen, certainly in the UK, we haven't seen huge deluge of claims around mental health, but everyone kind of expects that it will start to come at some point soon. And I'm sure that COVID will accelerate that, because being either being isolated or conversely being sort of asked to come back into the office or into whatever place of work when you don't feel 100% comfortable doing that, that's going to put strain on people as well.
Yeah, I mean, we were talking about this earlier, but I was, I'm one of the rare people that all the way through COVID, I got up and went to the office every day. Now, employees, they had the choice. They could work from home, they could work in the office, or they could do a hybrid. And, all of them basically took stay at home or work from home full time. But I'm one of those people that like to go into the office every day and work. When I go home, I leave my computers at the office. I'm not tempted to do all that, to do any work.
Yeah,
but
that's a good way to get a work-life balance, which many people don't have. So yeah, well done for that. It's definitely.
Well, I do get emails from people at 10 o'clock at night, 11 o'clock at night. An email will come through on the weekend. Now I'm not checking it, but I see it, and then I call them, like, why are you doing something at 2 a.m. on a Saturday? And they're like, oh, because I had stuff to do, and I just didn't get. And I'm like, really? You've got to take some time off.
Mm.
And I think I think there isn't, whether expressed or implied, that, people's actually work week has increased.
Mm.
And I think that leads to a lot of it.
Yeah, absolutely. It does. So, going back to sort of setting up a captive then, what does the kind of process look like? So, somebody gets to that point where they do that analysis, or they have a large loss, or they see one of your videos, or they're listening to this podcast and they think, oh, that's interesting. How long does it take from that kind of initial, let's check this out, to actually when you could implement that in the business?
Well, so with our process, if somebody reaches out to us, or we get referred by somebody, or they see a video, or they listen to your podcast or whatever, and we have a conversation with them, the first thing we do once we understand their business is we get copies of all their policies, because that's where it starts, to figure out, okay, we know you're in this business and these are the risks that you could be hit for. And it's not just the insurance risk, but we also have people that do a really good job at knowing the court cases. And this insurance company denied this claim for this reason. So it's looking at all of the potential liabilities for the business. Then from there, we look at your loss runs, and we put together an analysis and said, well, this should stay in the traditional market. This could go in your own insurance company. And this is how much reinsurance could cost. So it's like a preliminary analysis. So if somebody says, yeah, I want to do this, then it's probably, we have to do actuarials, we have to do feasibility studies, business plans. Every jurisdiction in the world wants to see at least a 5-year business plan with pro formas. So we put all that stuff together, we submit it, and you're probably talking to get it approved anywhere between 4 weeks and 6 weeks.
Okay.
With the department, with the regulators, for them to approve it.
Yeah.
In some places, let's use Grand Cayman and Barbados, they take a smidge longer, because they're more tedious, or work slower or whatever. Some of them are understaffed, which is an issue. But I'd say normally, I tell people 4 to 6 weeks once we have everything done and we get it submitted.
Okay, so if you're sitting and you've got your insurance policy with a traditional carrier is expiring in 6 months, now's the time to sort of start thinking about this, giving yourself plenty of headroom and a runway to sort of look into it properly and go through all that whole process and give time to get the approvals and things.
Yeah, correct. So 6 months is ideal. The ones that we have to move heaven and earth for are the ones when they call us December 1st and they're like, I renewed January 1st and my quotes are 300% more than they were last year. Yeah. So we'd like to look at this. So that's, we do get it done. But it takes a lot of people and a lot of hands on deck. But yeah, the more time we have, the easier it is. And also when you're talking reinsurance, reinsurers have specific times of the year where they're very busy. Like they're very busy because all the many renewals are January 1st and July 1st.
Yeah.
So if you go to them the Thanksgiving time or the beginning of November and you're like, hey, we have this new deal. Well, they're already working on all their January 1st. So sliding that in is difficult. So I found, just anecdotally, if somebody has a July 1st, I would rather deal with the reinsurers in August and September, setting the whole thing up, getting the quotes back and saying, if something changes, you reserve the right to reprice this, but you work through all of those things ahead of time. So they, it makes life easy for them. In the same time as they do a lot of renewals in July, and then quite often after their July 1st renewals, many of them will take their holiday. So I've also learned that you don't want to, give them stuff right after their stuff July 1st, because then they feel the pressure and you don't get as good of results.
Mm.
So there is some of that goes on. So the earlier you can do it, if it's a January 1st renewal, yeah, August is great, September is great. If it's a July 1st, start talking to them March, and they're very receptive. But if we come to them in June for a July 1st, we do get quotes, but I found that the pricing isn't nearly as favorable than if you give them a little bit of time to work on it.
Yeah, because they're not going to have the time to really consider it properly, so they're going to always put a bit of margin of error on top, aren't they, to cover themselves, I suppose.
Yeah, correct.
Yeah, which is human nature.
Yeah,
we can't tell them off. Can't tell them off for that.
Yeah, the client I was meeting today was February 1st renewal.
Okay.
On their workers' comp.
Yeah.
And they've had their workers' comp in their own captive insurance company since 2016, and it's been hugely profitable for them. And but at the same time, we wanted to set it up. We wanted to get all that information in early so we can get it to them and then take it off their plate. So, everyone's not stressed, in December and January.
Yeah. Yeah. Which is not a good time of the year to be stressed.
Yeah, exactly.
Holiday season, try and relax, going back to your earlier points. So you mentioned you've got your YouTube channel with lots of videos and resources. Is there any other thing that you'd recommend that people do if they have listened to this and it's piqued their interest and it sounds like something they'd like to look into more? Check out the videos, but is there anything else that you'd recommend people do, or could they contact you directly and talk? I mean, I guess you can help a company anywhere in the world to move forward with this if they're interested.
Yeah, correct. So I mean, we do have offices here in the U.S. So I'm here on the West Coast right now. We have one Honolulu, New York. We have an office in Grand Cayman and North Carolina, Tennessee. So we do have stuff all over. But I would say if they're interested in captives or want to learn more about it, go to our website. It's Risk Management Advisors. It's Risk MGMT, like M Management Advisors, ADVISORS.com. There's a quiz you can take to see if captives are right for you. There's the Ultimate Guide to Captive Insurance, which they can download and get a copy of. I have a book called Taken Captive. It's available on Amazon. That goes through, and it's really just a primer for business owners on captives. But our YouTube channel does have good videos with good content, and it's RMA Captives. But the good thing is there's a bunch of channels within there, and one of them is Captive Insurance 101. And it just has all the basics. What is a captive? Why do people do them? How the history of captives, how long they've been around. And then for like quick and dirty, if somebody wants information on captives, this isn't branded for Risk Management Advisors, but it's captiveinsurance101.com. And it has tax court rulings. It has, all the information that's on our site is on there, but it's unbranded, and it just gives them basic information. And I find clients are one of two ways. They want to know what time it is and they don't care about how the watch works, or they really care about how the watch works. So that's where you can dig into what are all the rulings, what are all the rules and regs, the different jurisdictions, what do each one require? So it just, I would say that's a great place to start.
Yeah, perfect. No, that's congratulations for setting all that up as well. I think it's really important to and for doing the book and everything. It's really a great idea to try and get as much knowledge out there around what you do and the principles and give people all those tools, because I think it really just helps to put people's minds at ease and get them, comfortable with what they're about to embark upon. And, if you're the person that's given them those resources, then they're likely to kind of come to you first. So I think that's a very smart business strategy.
Let's hope so.
Let's hope so. Exactly.
Yeah.
Great. Well, Wes, I really appreciate your time. Really enjoyed it. I certainly learned a lot, and I'm sure the audience did as well. Really encourage everybody to check out those resources. We'll link to them in the show notes as well. Is there anything that I forgot to ask you before we wrap it up, or any last words you wanted to get across?
No, Christian, I just want to thank you for taking the time and reaching out, and this is great. And I've learned so much on your previous podcast. I subscribed, and you have got really good listeners. So I would tell everybody, make sure wherever you get your podcasts, make sure you subscribe.
Definitely, because it helps to, it keeps my motivation going when you see the subscriber numbers coming in, and it helps to spread the word as well, because, what we're trying, similar to what I just said about what you've done, which is great, the idea of this is just to get that knowledge out in the world and educate people and enable people to make smarter decisions about safety and risk. So, if we can help by subscribing and sharing and all those things, then that's going to help other people. That's a great thing to do as well.
Yeah. Well, thank you.
Thanks a lot, and we'll see you, everybody that's listening, next time for another good interview. Cheers.